Hello, everyone. Thank you for joining in today. This is Andrea Wilson, the broker over at Brickhouse Realty. If this is the first time that you're joining me, so today I have a special guest with me. His name is Dustin. Now, Dustin, believe it or not, I have a really hard time with your last name.
That's
I need to.
Pasalacqua.
How do you say it?
Pasalacqua.
Okay, Pasalacqua. Okay, that's not so bad.
There we go.
Do you get that all the time?
Yeah. I just say just call me Dustin P. Just call
Okay.
DP, Dustin P, Dustin. We're good.
Gotcha. All right. So I have Dustin P with me from AFI Mortgage. So what I did was I went to Google and I did a search on the top questions about around mortgages. I get questions on a daily basis. I'm not a mortgage person. I just take you to see the houses. Although I do like to be informed, I like to help educate you through the process, but I leave it to the true experts like Dustin to help get through, to answer the real hard, tough questions. So, Dustin, can you formally introduce yourself to
Yeah.
everyone?
Yeah, my name is Dustin Pasalacqua. I'm a certified liability advisor and branch manager with the integrity team with AFI Mortgage. Um, I like long walks on the beach. I'm a Sagittarius, and yeah, I really love helping families and educating. So yeah.
All right. So we're going to really just go ahead and start diving right into the questions. So the top question that came up, which is kind of a combination, I believe, between lender and realtor, but it was how to buy a house. So because I Googled around mortgages, how would you answer that from a mortgage perspective?
Yeah, it's a great question. It's going to be a little bit of a loaded answer. So, how to buy a house? Well, it really starts with, for an example, with us, what we start off is a discovery call. And that discovery call gives us an opportunity to figure out the most important question: why do you want to buy a house? Is it because you're sick of paying somebody else's mortgage? What are your short term? What are your long term goals? If you plan to relocate in 6 to 8 months, it might not be a good idea to purchase a home. So we're really trying to figure out what the time frame is. We're looking at what the overall costs are going to be. Are you going to be able to recoup those based on the amount of time that you want to be in there? And then we're looking at our long-term goals. So we're really trying to set up, what is it going to be in the future that you're going to want to do? And that is really how to buy a house, because if it fits in with what your short term, your long term, it fits in with your retirement goals, your family, that's really what really goes into buying a house. Now, naturally, you're going to have your transactional side of it. You're going to have, we're looking at your credit, we're looking at your assets, we're looking at, job history. We're looking at compensating factors, what type of loan program that you're going to go into, where your down payments. So it really starts with just really connecting with a mortgage planner to really discuss, is this going to be a good financial move for me? Does it make sense? But also just having that agent really involved as well, because we're really a big team, so you really
Mhm.
can't purchase a home without one or the other. So buying a house it doesn't really matter who you reach out to first, to be honest with you, because I honestly think that we both have our perspective fields, but our expertise that we can advise the client on. But yeah, I would say that that's pretty much how you buy a house. You apply, you have a consultation. So nothing really beyond that.
I think that one of the biggest things, so what's happening right now in the marketplace is values have really shot up. And so they're starting to come down right now. So what's happening when the values have gone up, and even still, people that are renting are experiencing or having troubles right now in the marketplace. They are being told by their landlord, like, oh, we're selling a house, here's your 30-day notice and you need to move. And so what's happening is I'm talking to daily renters who did not plan to purchase a home, but now are forced to try to find a rental, can't find a rental, but their credit is not in a position and savings where they need to have it. So they are scrambling right now. And I think that part of it is, even if you in your mind say a year or 2 years out, could someone call you and say, "Hey, I'm thinking about buying a house in a year." Can they call you to review their credit, or, and then the other piece is they get caught up and they heard that pulling your credit for a home loan is going to drop your credit score.
Yeah, no, those are really good concerns. So, we'll tackle your first question. So you should actually be reaching out 6 months into a year in advance, anyways. It doesn't matter. And one of the reason is this is the largest financial and emotional decision that you're ever going to take on. And you, by clicking a button, and I'll say it, you just going on there and just clicking a button and getting a pre-approval with the Rocket Mortgage, that's click of a button should not be a mortgage. So you should really, you should really be setting the foundation early to ensure, do we have any credit challenges? Even if you don't have any credit challenges, what about getting your credit up to speed or up to that next tier? Because what your credit score is going to really impact, sometimes what you can borrow, because it depends what program you're going to go into, and B, how much it's going to cost for you to borrow, right? So we have ways of boosting scores in a very short period of time. Giving you an example, let's say that you have 5 credit cards, and let's say that your balances are over 30%, which you want to keep them under 30%, right? You always want to pay above the minimum payment. But let's say that they're 50, 60, 70%, and they're small. They're like rinky dink, $500 to $1,000 credit cards. What happens if I was able to tell you, listen, I've ran a score simulator. You're ready to pay $350, allocate that to all those credit cards, and now I got your score 30, 40 points higher, which is going to result in 0.25% lower in an interest rate, which might result in a $50 to a $75 a month cheaper payment, which could be that could be substantial depending on what your overall financial picture is. So to answer your first question, always get a proactive approach, set the foundation early, make sure that you have all your ducks in a row. Number two, no, it's not going to hurt your scores. And this is actually a really good point. This is a huge misconception that if I apply for a mortgage, it's going to drop my score. First of all, Credit Karma is not FICO 4, okay? We look at FICO 4. FICO 4 is the mortgage. It's a classic mortgage FICO. And the government-sponsored enterprises, GSEs, Fannie, Freddie, they're not going to change that for any time soon. So that's what we look at. And it's always going to be different than Credit Karma, Credit Sesame, Experian. Another thing, too, is if you don't know, the credit bureaus it does not affect you for a mortgage inquiry, okay? So the federal government, they want to incentivize people to buy real estate. This is why they kept the economy going with pumping, with quantitative easing, keeping that money going through. And the real estate market is really what carried us over. So they don't want to decentivize anybody. They want to incentivize. So no, you're allowed so many inquiries within a 45-day period. Now, if you're out there shopping for a car and you've got 15 auto loan inquiries and you don't have a good payment history and your stuff's maxed out, yeah, it's probably going to affect you, but it doesn't matter who pulls it. So to answer your question, no, you're allowed to pull it so many times, and it's noted as a mortgage inquiry, so it doesn't affect you, just like medical doesn't affect you either. So hopefully it answers your question.
Yes, thank you. And thank you for the level of detail. I feel bad because I kid you not, daily someone is calling and they didn't prepare because they just thought that, oh, I'm just going to be renting. And the lack of preparation, they got hit over the head from their letter from their landlord saying, hey, I'm selling this house. But now they're going to the marketplace and the prices of the rentals have shot up, right? So that's the first thing. And then number two, their credit is just not as strong. Okay, so that next question that came up on there is what credit score do I need? That was the second most asked question per Google on there. So what type of credit scores do buyers need?
Yeah, really good question. I just want to kind of piggyback off of the rental increase. So if anybody doesn't know, the year-over-year rental increase went from 4% a year to 15.5%. Rent.com, you can look it up, cite it. and the average market rent is about 1766. So you're either paying somebody else's mortgage or you're paying your own. So you got to pick, right? So in regards to credit scores, yeah. So you're going to have basically the two most common is going to be FHA and conventional. Now, VA doesn't have a score requirement. FHA has a 500 minimum. Conventional has 620. Now, that's one part of the equation. The other part of the equation is figuring or finding the investor that is willing to loan the money at those prospective credit scores. So the general, like for us, for an example, 580 is the minimum score that we will allow. We'll go with FHA. VA is 580. Okay. Now, conventional 620. Now, just because conventional allows 620, that doesn't mean that it's going to be good, because you're going to have a two-part factor unless you're putting 20% down. You're going to have mortgage insurance. Okay. Mm-hmm. And it is risk-based, and you're not going to be able to price the mortgage insurance out with a 620 score, because you're going to fail what we call a qualified mortgage rule, okay, which is a specific amount that you're actually allowed to be charged in general. So 680 and above, you're going to probably push into that conventional category. But if you have more money down, you could get in there in the mid 600s. And then FHA, VA, 580. I haven't seen an investor that's really priced out below 580. It's just very difficult, especially since COVID hit. And for the time being, going forward with rampant inflation, with the unknown with the housing market, because of the fear-mongering news, you're not going to see a lot of investors that are going to be under that 580 marker. And if you are under 580 with FHA anyways, you're required to put 10% down as opposed to 3.5% with your standard 580 score and above.
Yeah, anyone that comes to me, I really, for going FHA, I tell them I need you to be at least 620. That is the minimum. And if we have that conversation below a 620, then my next question is always, how much money do you have in savings?
Yep.
That makes the difference. And that term of money talks is so true, and people don't realize that, how important that is. You can't come to the table and have nothing. We had a situation recently where a young lady, she had 2 bankruptcies, right? That happened in 2019, which, okay, that's older, but 2019, 2 bankruptcies. She had 0 savings. Her score was at about a 650, but she also had 6 late payments on a car note within the last year. So her credit score was good. She had no savings. The bankruptcy. So you have all of these things against you, and then you're asking for someone to take a chance. Somebody on the other side of a computer to take a chance.
Random. They don't know anybody. Yeah, it's random. Yeah, you're right.
To take a chance on you. And so I feel like that person kind of shows up and they're like this, please, 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 please pass me. And I really want to see more people stop having to kind of do this in hopes of, and just work on, do the work before you need to purchase the home. Put that money away in savings and work on that credit piece.
Yeah, no, that's a really good point. So first of all, I can tell anybody that's watching this, if you have a bankruptcy and you have any lates after that bankruptcy, your chances of approval with FHA are slim to none, because anytime that you have any recent, like, it's technically 12 months. Okay. So if you have any lates in the first 12 months after bankruptcy, you're roasted. You're done. You're not going to get AUS approval. And seeing that many lates on just a car note or even a credit card, I'm not saying that's irresponsible. What I'm saying is you're looking to take on, a responsibility that is 10 times of what you couldn't own up to before. We're not looking at you like a bad person. I'm just looking at you stating, listen, I have a fiduciary duty to you as a mortgage planner, and I've told the clients, I don't feel comfortable doing this. I don't. I can't tell you no. Okay, because I'm violating fair housing. But what I can tell you is I can give you my opinion based on my field, and I'm allowed to do that, and I'm supposed to do that. And I agree with you. You probably shouldn't be buying a house at that point. Save something up. Now, there are down payment programs. Down payment assistance it is rare compared to what we have seen in the past couple of years, because there's a lot of uncertainty, and the rates are at an all-time high, and they're going to continue to be volatile for the short period. But there's situations for those down payment situations. Somebody that has excellent credit, and I've had it before, but they don't have that much disposable income, but they pay their bills. They make that responsible effort. But maybe they got 2 or 3 kids. And at that point, I don't want them paying somebody else's mortgage. I want you paying your own. You have demonstrated financial responsibility. You just need some help.
Yeah.
That next step. And those are the people that I would rather than somebody that's irresponsible. So yeah, sorry, I didn't mean to get carried away on that.
No, this is good conversation. I mean, they don't really understand how much of a risk, because at one point a lot of lenders didn't even want to offer, like mortgage companies didn't want to offer down payment assistance programs because of the high level of default, because of the lower credit score requirements and high level of default. So even though it's available, but people are literally on that back end are risking their jobs. Like if they have so many defaulted loans on that back end, these underwriters, it's like a scorecard, and they could potentially lose their job if they have too many scorecards. So if your job is on the line, I know if my job was on the line, I'm going to be very cautious and careful who I'm signing off of for a loan.
Yeah, it's an EPO, so it's actually a default. It's called a default agreement. So if the way that works with investors, mortgage companies, lenders, is if you sign agreements with investors, right? And for an example, if you refinance, you paid your loan off, like for an example, if your agreement is standard 6 payments, you pay that loan off in 6 payments, that company has to pay back a portion or all their commission back to that company. Now, if you have defaults, that's a different story. If you have, it's either a 60 or 90-day late in the first 3 months, you have to, it's called a scratch and dent. That investor will make that company buy the loan back.
Wow.
And then they have to hold it. They either have to front that, hold it, and sell it off to the secondary market if they have an opportunity to do so. So you can actually bankrupt that company. And the underwriter, it's their discretion. You're right. They're signing off on it. FHA might insure it, but it doesn't matter. The investors still want their money, and they're going to cut ties with you. They're going to make you buy it back. You're going to destroy liquidity with that company. And yeah, you're right. They're going to fire the underwriter. Wow. So I can tell you right now, yeah, you're definitely right. Underwriters are scrutinizing more than ever right now. A, because the jobs are limited, and B, because of where the market's at. Wow. So, yeah.
All right. So that number 3 question was, how much money do I need to buy a house? So, and I know depending on programming, that kind of could vary, but could you touch on that for a little bit?
Yeah, so it depends what loan program. VA, the standard is 100% financing. You've earned that right. You fought, you sacrificed for this country. Take the right. You earned it. And then you're going to have FHA standard 3.5%. Now, if you can't get it, you don't get what we call as AUS approved eligible at 3.5%. Sometimes you put 5% down. You might get that approval. And then you're going to have conventional. Conventional, it's 3 to 5%. So there's the first-time home buyers, if you define as Fannie, if you haven't owned a property, I believe it's in 2 years, you can qualify for 3% down, depending on where your credit situation is. And then if you're a repeat buyer, subsequent buyer, they also have what we call as Home Ready, Home Possible, which is reduced mortgage insurance, reduced interest rates, but you have to be under the 80% of the area median income. And it's really easy. You can go Fannie Home Possible or Home Ready, Google it, figure out what the area median income is in that area, and it'll tell you, and that's a 3% down as long as your credit qualifies. So the most standard, though, is 5% down for conventional, 3.5% for FHA, 100%. And USDA, I'm not going to lie to you, I don't specialize in it. I know they have 100% down programs, but never done one, and I don't plan to do one. So.
Okay. Yeah. So, quick question: from time to time, buyers are required to put money in reserves. Would that be part of that 5%, or is that something totally separate from that?
Yeah, that's a really good question. So reserves, it's a case by case scenario. So Fannie, Freddie, they technically don't have a reserve requirement. Neither does FHA. They don't have it now. Now, a reserve requirement, for an example, would be if you got a job offer. Let's say that you wanted to buy a house, but you're going to be in between jobs. I don't recommend it, but it happens. Or you're moving out of state. Perfect example. Let's say you're moving out of state and you lock a job and you got a salary letter or an hourly letter, right? You can actually close the loan as long as you move in there within 60 days, right? The automatic reserve requirement with FHA, for an example, would be from the time that you close your loan to the time, as long as it's within 60 days, from the time that you make your first payment, you have to have your mortgage payment. Okay, it's 30 days. Let's say, for an example, it's 30 days. You have to have that plus all your expenses. That's an automatic reserve requirement. Fannie Mae, they're less forgiving. They make you have either 6 months reserves of all mortgage payments or all of your bills plus, I think, like 2 payments, 1 payment plus 1. So reserve requirements, they will help you. It's called a compensating factor. So let's say that your scores are not above 720. Let's say they're 680, right? You having 2 or 3 months of your mortgage payment is going to help your situation. Okay. But to answer, you technically, there's only certain circumstances. Now, if you're buying an investment property, for an example, then you have to have required reserves. And depending on how many properties you own will dictate that. So it's either going to be, it's between 2 to 6 of the monthly payments and reserves.
Real quick about the investment properties. How much of, if the investment property is already cash flowing, how much of that rent income can you use as part of your income?
Yeah, that's a really good question. So you can use FHA and conventional financing. Well, FHA, as long as you occupy it as a primary, you can use 75% of whatever's on the rent schedule. Or if it's leased out, you have to go 75% of that lease. Okay, you can use that to qualify. If it's same thing with the investment. If it's on the investment side, you can use those active units, 75% of either what the rent schedule is in the area or whatever's on that. So you technically could use FHA 3.5% down. You could buy a 4-unit property and you can make not a job and you could still qualify as long as the rent schedules cover that mortgage payment. Easiest house hacking tip ever. You want to start building a portfolio? This is how you do it. You buy a 4-unit, okay? Then you move into a townhouse. And then you move into a smaller single family. And then you move into a bigger single family. And you're using the minimum down payment. But I always use the FHA first. I love it, 3.5%. Now, Home Possible, conventional, most people don't know this. They switch things around. Up to a 4-unit, you can get in there 5% down. Now that you have to be Home Possible, which means you have to be under 80% of the area median income, and those units are going to count towards that overall income. So you got to be careful. 3% has to be derived from your own personal funds, though. But otherwise, standard FHA. So hopefully that answers your question.
You guys that are watching, if you're watching a replay, he just gave a whole play. Like, rewind, write that down. He just gave some tidbits of information. I feel that especially if you are a young person, the play that he just gave, the tip that he just gave, I feel that you should start with that. Start with a multifamily house and kind of do that house hacking method. Do it before you have all of the baggage. The baggage is the relationship, the kids, all that extra responsibility that's going to limit you from living in a 2-bedroom unit, right? Because if you're going FHA, you're going to have to live in that property. And so if it's a 4-unit, you're going to have to live in one. I believe a minimum of a year is the requirement that's on there. So you could literally live in this place rent-free, mortgage-free, because the other tenants are going to pay this thing off for you. I love this type of strategy. I think not enough people do this. If you are here in the Cleveland market, you definitely should be taking advantage of it because our real estate here is cheaper than most of the country. So that's my rant on that piece of it. I do have one more question that was on that top search, and it's how much money do I need to make to afford a home? that can vary, but just what's your take on that? Obviously, it's a question because people keep Googling the question. So, how much money do they need to make?
Yeah, too. I wanted to just piggyback off of your last. So if you're actually going to be into house hacking, you need 100%. Once you get your financing, you're okay. You need to get with your agent. They're going to do the prospective work for you in that area, and they're going to look to target areas where we have a high rent schedule. And just because if you're buying $300,000, $400,000, $500,000 house, listen, you can still get, if you're a good prospective buyer, you can get down payment assistance. You can get a 1-to-4 unit with no money out of your pocket, and you can house hack. And one of the other things too is, remember, that's the whole point of retirement, everybody, is what is the whole point of retirement? To have passive income to cover your expenses so you don't have to work. Okay? That is real estate. That is secured passive income. In the most secured passive income that now is rising at 15.5% a year. So if you know that and it's passive, and guess what? People don't know. It's called inflation-induced debt destruction. Your debt is being eroded away by inflation. If inflation's 3% a year and you have a rate of 3%, for an example, okay, which they will be back 3 to 4s, that's being eroded because your income increases at 6 to 10% a year, depending if you're private or public sector. And then your rent increases at 15.5% a year, and it's tax-free. So if it turns into an investment and you cash out of it, the money's tax-free. So that's just another thing. That's my rant on it.
Wait a minute, Justin. I thought of one thing real quick. What about, it's popping up, it's very popular right now, Airbnbs. How would they look at income on a property that was used as an Airbnb rental?
Schedule E, rental.
Okay.
You gotta have you're gonna have to have your agreements, you're gonna have proof of deposits. Fannie Mae, Freddie Mac each have their prospective guidelines, but you're going to need to show it's minimum 1 year on the tax returns on your scheduled real estate, and then they're going to want to see, obviously your renter's paying. If you have a payment, or it's obviously it's better than if you're just renting it out, but they're just gonna average it out. They're going to see that it's consistent. You have a contract and it's on your Schedule E. So yeah, minimum of 1 year, I'm pretty sure. So don't quote me. It's 1 year minimum, definitely 2 years all day long. So yeah, you can use the Airbnb as long as it's documentable. So how much money do I need to afford a house? The general rule of thumb is 28%. I mean, it's a Google search. 28% of your gross monthly income. To be honest with you, 28% to somebody that makes $1,500 a month is going to be significantly different from somebody, or if it's 30% of somebody that's making $15,000 a month. So what we really do is when we have our consultation, we're looking over the credit. We're figuring out, are there any debts that are not reporting on credit? What are your expenses? And, my theory is what are you paying in rent right now? How consistent have you been with that? And what is your comfort level? So, for an example, let's say that you have somebody that's frugal that makes $3,000 a month, right? And their mortgage payment, and they don't have any other debt, and their mortgage payment's going to be $1,400 or $1,500. Either you're paying the mortgage there or in rent. You're at 50% of your monthly income. What am I going to tell that person? No, you've been responsible. You've paid your rent. You're over 28%. You can't afford it. No, I'm going to look, I'm going to look at it objectively. Okay. And I'll give my subjective opinion on it. But as long as you have demonstrated financial responsibility, I'll give you the green light. I'll give you the heads up on my recommendation, because it doesn't, the relationship with your mortgage planner should really start when you close the loan. And what I mean by that is he should be, and a lot of the times it's transactional. I'm sorry, in our industry, we lack financial literacy and we don't know how to run a business. And we should be treating our businesses like practices, just like you do, Andrea. It's a practice. You are going to be there for the longevity. So that's what the mortgage planner should do. But he should, if your mortgage planner is not asking you these questions, like what's off of your credit, what's on your credit, what do you feel comfortable with, what's the max that you can afford, things of that nature. And if he's just giving you a payment and an interest rate, it's wrong either way you look at it. So I really look at what their comfort levels are and what they're currently paying right now, because that gives me a good idea to establish, can you afford it or not? Now, if you're doubling up your payment, that might be a problem. If I don't see financial responsibility, it's payment shock. It really is. FHA has a rule against payment shock. So I think it's like 150%. I think if it increases on your rent to your mortgage payment, they'll boot you because it's payment shock. So it's a loaded answer, but there's really no determination that you can put on there. It's what are you comfortable with, and what are your expenses, and where do you plan to be going forward. So yeah,
Perfect. I do have one extra question.
yeah,
You have that bookshelf behind you. I'm a
mhm,
big book reader.
yep.
What's your favorite book? What I'm gonna grab my pen. What do I need to add?
I mean, I just I just finished. I don't have it down here. It's called The Magic of Thinking Big, or the that one was recommended by Steve Harvey, and then The Power of Positive Thinking. That's another one by Steve Harvey. I follow him a lot. I really like his story. If you don't know, you should read up on his story. Probably, yeah. Atomic Habits by James Clear is really good. Uh, Extreme Ownership by Jocko Willink. I mean, that's good. I don't really have a favorite. I mean, anything that I'm really big on personal development, so I'm constantly evaluating myself and every single day. So, yeah, anything that really, honestly, every book they all have the same premise.
Yeah.
It's just who delivers it, who frames it the best, and who can you relate to. But those are some of the books that I really like.
Well, thank you for sharing that. Thank
Yeah.
you guys for joining in with us. If this is your first time joining, make sure you subscribe, you like, comment, and share this information. The replay will be made available to you. If you're thinking about buying a home, selling a home, investing in real estate, you can reach out to me. You can reach out to Dustin. Dustin, is that your social media handle?
Yeah, that's my IG. And yeah, so we're the integrity team with AFI Mortgage. But yeah, I mean, like I said, Mortgage Planner Dustin, that's my IG. I try to drop daily content on my TikTok, my IG, just as much as I can get out. So always dropping some house hacking tips, anything in regards to finance. So yeah, anything that we can do to help, we will.
Yes. Thank you. And if you're not following him, please do follow Dustin. He does do a wonderful job with providing great quality information to you guys and educating you around just the industry. Just listen, go back and listen to the tips and gems that he gave in this conversation alone. So thank you for joining me. I'm sure I'll be in contact soon with you. Keep doing what you're doing, and I will see you next time.
Thank you, Andrea. Thank you for having me. Stay tough out there, okay?
All righty. Bye
All right.
bye. See you guys.